Welcome back to the monthly portfolio update. I hope you'll find the information in this video useful, but disclaimer, please note that this is not investing advice. It's just my portfolio as it stands on Friday, March 1st, and it can change at any time without previous notification. Following an investment strategy without doing the work yourself is almost guaranteed to result in losses. So please be careful, since it's your responsibility to do your own research before investing. Also, in the bonus section, we'll be discussing a super sexy subject, general semantics, or how the map is not the territory and what that means in investing. I know, I'm as excited as you are about the subject, but first let's look at the second month of 2024. This month I bought a little bit more Alibaba, which to be honest surprised me as well. However, I think that the bad news from last year seemed to dissipate quite a bit. Of course, there are still worries about China's economy, but I doubt that a behemoth like Alibaba won't be able to make it through the other side and at the same time buying back a lot of shares and overall improving profitability. I think that a few times a year I need to reevaluate my holdings and see if the investment thesis still makes sense. Then if it's underpriced and I have a strong cash position, buy more, or if it doesn't seem like a good investment anymore, have to sell it. So I bought me some more Alibaba. Wink wink. I also bought a 3-year corporate bond for Impact Developer and Contractor, which is a real estate developer in Romania, with a coupon of 9% a year in euro, since a big chunk of my government bonds expired last month and medium to long-term yields should theoretically go down in the future. Last but not least, I also got a very small position in some altcoins. These are just so I can learn and play with them, earn, convert, stake, etc. On the other hand, as you can see, there was no selling this month, which is the goal. In terms of cash flow, I had just the one coupon paid by my other corporate bond from Restart Energy 1. And in the second month of the new year, the portfolio as of March 1st, 2024 looks like this. Please pause the video if you want to analyze each investment in detail. There is a single new addition, IMP27E at line 17, which is the Impact Corporate Bond I mentioned earlier. The overall portfolio return this month was 2%, the second best single monthly return since I started investing in 2009, and by far the best since I've been doing these portfolio update videos. Year to date, the portfolio is up 2.67%. That being said, the current pyramid allocation portfolio looks something like this. You can see the increase in ARR assets, which right now is only crypto, that mostly drove the portfolio returns this month. Of course, we shouldn't get too excited since crypto assets are by definition volatile and they can go down as fast as they went up. So I'm happy, but with some moderation. Also, the S&P 500 performed relatively well this month, while my Romanian stocks underperformed since most companies reported worse 2023 results than the year before. And last but not least, you can also see the addition to bonds reflected in the pyramid, which basically switch a little bit the mix to risk on from government to corporate bonds. Before going to the next section, please don't forget to like and subscribe to the channel. It really helps bringing this completely free information to more and more people. In today's bonus section, we discuss a super sexy subject, general semantics. I'm being ironic, of course, or how the map is not the territory and what that means in investing. While the name might not bring excitement to many, it's actually a very important lesson in investing, especially today when we rely more and more on passive investing and reports and analysis made by third parties that we take for granted. So, what is general semantics? The concept was introduced by Alfred Korzybski, 115% I butchered its name, but you can find it in the link below. And general semantics is concerned with how events translate to perceptions, how they are further modified by the names and labels we apply to them, and how we might gain a measure of control over our own cognitive, emotional, and behavioral responses. In the army, because it can be the difference between life and death, there is a saying that the map is not the territory, which basically means that the description of the thing is not the thing itself. The model is not the reality. Similar to how the menu at a restaurant is not the real meal. The steak might look great on paper, but when it comes undercooked, you might have some stomach problems later. So this is all great, but how does it apply to investing, you ask? Great question. Some common investing misconceptions, also known as mislabelings, are ESG, which stands for Environmental, Social and Governance. While probably the least important on the list, I started with this one since we witnessed a full life cycle and investors and company kind of woke up and started arguing, in my opinion correctly, that ESG is not all that was promised in the name. For example, Tesla scored really badly, while Exxon and other oil producing firms scored near the top, which doesn't really make any sense. Next, we have GDP or Gross Domestic Product, which is another one of those terms that people use to forecast the productivity of a country. However, it actually doesn't measure it at all that correctly. For example, if you mow your own lawn and your neighbor mows his, there is zero GDP growth. But if you pay your neighbor's kid $20 to mow it and he pays your kid $20 to mow his, then you suddenly have a $40 increase in GDP. But in reality, nothing was achieved in terms of productivity. So there are things like Wikipedia, which is free, that bring a lot of value to a lot of people. I just shared the link previously, but is not included in the GDP numbers. And one last point on this, GDP should have a depreciation component. For example, if a house lasts for 100 years, instead of being badly built and needing a lot of repairs over the years, it's actually worse for GDP. Same with a phone or TV, if you have to change it every few years because the producer sends an update to make it slower, it's actually viewed as a great thing in terms of GDP, but it doesn't really mean that it's a healthy growing economy, rather the opposite. Next, we go to ETF names, which are more and more important due to the rise in passive investing and reports and analysis made by third parties that we take for granted. I don't really want to single out any individual ETF since that is not the point, but a simple Google search will bring you the information you want. As general examples, there is a leisure and entertainment ETF not containing Disney. You would think that the behemoth that is Disney in both leisure with the theme parks and in entertainment with the streaming service should be included, but it isn't. Or some of the home builders ETFs with only 30 to 40% of assets in actual home builders. And last but not least, my arch enemy, inflation. Now, this is a longer talk and hopefully one day I will make a video on why I don't really believe in inflation, but we see this term every day and anchor everything on it. For example, the returns of our portfolios. But actually, there are very big problems with the way the inflation is created. You can research this yourself, but for example, there is no real reason why x should be 0.000 whatever it is of the formula. And secondly, the methodology of tracking is antiquated and basically incorrect. In order to track the price, someone goes to a certain store and checks the price on one type of egg every month. But instead, there should be an average of all eggs from all producers, which now with the internet and big data, it can actually be done. Also, a second main reason is that it really doesn't matter how many eggs you eat, since there is something called elastic and inelastic demand for products and services, which means that while theoretically everything goes up the same with inflation, in practice, a big ticket item like a car or a house, which over your lifetime will be the most important chunk of money you spend, is not really directly correlated with inflation, but rather it depends a lot on the timing of buying or selling of such an asset. The actual price you'll get or pay for it is not the inflation adjusted average price in your area, etc., but rather a super particular price to your case. So, You can either get a premium when you sell your house or a big discount if you really need the money and there is no demand at that time. Anyways, there are many finer points on this, but I hope you get the message. Don't sweat too much if the number is up by 0.2% instead of 0.3% or down by 0.1%. It really doesn't matter all that much. Anyway, today's main lesson is labels can be deceiving. Understand that the thing itself, not the label or spin that Wall Street puts on something. Also, on a related point, they could even change a name. For example, UFOs are now UAPs, unidentified aerial phenomenon, even though we don't really know anything more than we did when they were called UFOs. So they might try to say, no, ESG was a failure, but now the new improved ESG called whatever is much better. Similarly, they may come up with a new way to calculate inflation of GDP and tell you it's much more reliable. But you have to reapply the same process and check if that is true for yourself. As the saying goes, trust but verify. That's it for today. I hope you enjoyed the video. If you did, don't forget to like and subscribe. Most people that watch the videos are not subscribed yet, so not sure what you're waiting for since the price will never be cheaper. Wink wink. See you next month. La revedere. That's bye bye in Romanian.